On April 10, 2023, during regular trading hours at the New York Stock Exchange, a seemingly routine update to a financial trading algorithm developed by the tech firm QuantCore Intelligence set in motion a sequence of events that would eventually destabilize the stock market. QuantCore Intelligence, known for its sophisticated algorithmic trading solutions, had recently deployed a performance enhancement designed to improve the efficiency and speed of its automated trading executions. This update was part of a broader strategy employed by many firms looking to maximize returns in a rapidly evolving digital marketplace. The update involved a reconfiguration of the algorithm's feedback mechanism. Originally, the algorithm relied on simple market signals to guide buy and sell decisions. However, the latest version introduced multifaceted analytical inputs, which were meant to increase responsiveness to market conditions. This change proved problematic due to a misconfiguration in the algorithm's interpretation of high-frequency trading signals. As it adjusted to new inputs, the algorithm began reacting disproportionately to minor fluctuations in stock prices, creating a feedback loop. The core issue lay in the reliance on real-time data from a limited array of sources, combined with a poorly configured override function designed to prevent excessive trading. This oversight allowed the algorithm to trigger multiple trades based solely on marginal price shifts, leading to unintended consequences. Within the first hour of trading, the effects of the algorithm's misconfiguration became evident. QuantCore's algorithm initiated a flurry of automated trades, significantly increasing the volume of sales for several large-cap stocks, including major companies in the technology and finance sectors. This surge resulted in a 30% increase in trading volume for the affected stocks, leading to a sharp anomalous decline in prices. The situation escalated as competing algorithms from other firms interpreted the rapid declines as signals to act, triggering their own automated sell-offs. The result was a cascading effect. As more algorithms engaged, a perfect storm of selling ensued, ultimately causing a sharp drop in the overall market index. The initial measurable impact was drastic. By 10:30 a.m., within just 2.5 hours of the incident, the S&P 500 index had plummeted by nearly 5%, erasing billions of dollars in market value. In dollar terms, the estimated loss approached $1 trillion, triggering automatic suspensions of trading for numerous stocks. As the market dipped, individual retail investors began bombarding QuantCore's communication channels with concerns over sudden drops in their portfolios. Net losses for some high-frequency trading firms, who relied heavily on predictable market movements, were noted to be as high as 70% in certain strategies, leading to increased panic within trading floors across Wall Street. Internally, the immediate reaction at QuantCore Intelligence was one of confusion and disarray. Emails flooded the internal communication system as employees attempted to understand the magnitude of the unfolding crisis. The incident response team was activated, and a dedicated incident channel was established for rapid updates. Initial assessments pointed toward an unanticipated behavior in the newly updated algorithm, although key personnel remained divided on whether this was a singular issue or part of a more systemic failure. While some engineers sought to patch the program with temporary fixes, it quickly became clear that the problem was more complex than anticipated. Meanwhile, external signals began to surface. Independent monitoring tools triggered alerts as market volatility soared. Prominent financial news outlets began reporting on the prevalent sell-offs and the anomalous trading patterns observed that morning. Social media buzzed with speculation, and finance forums lit up with discussions regarding potential market manipulation, even as major broadcasting networks began to inquire about what might be causing the downturn. User reports described a jarring experience among retail traders logged onto their platforms with latency issues and unexpected trading actions noted, compounding the sense of instability while exacerbating anxiety across the market. By noon, the initial confusion had transformed into a growing realization of the scale of the crisis. Internal teams at QuantCore scrambled to stabilize the algorithm, but it became increasingly clear that they were dealing with a scenario far beyond a simple software error. Analysts pointed out the emerging patterns. Algorithms across the industry were acting in tandem, creating an interconnected web of electronic trading that was spiraling out of control. Financial experts started to question not only QuantCore's latest algorithm, but also the implications of other automated trading systems relying on similar technologies. The finger-pointing began, with concerns directed not only at QuantCore's misconfiguration, but also at the broader market ecosystem that allowed for such rapid feedback loops between algorithms. As the afternoon progressed, efforts to halt the algorithm's destructive influence met with mixed results. Despite attempts to disable the glitch, numerous trading firms continued to see cascading effects across their own platforms. The decision to intervene meant carefully weighing the risk of further exacerbating the situation against the necessity to restore order. Tension heightened within QuantCore, as executive leadership faced mounting pressure from both stakeholders and external investors to provide clarity on the incident. The situation had escalated beyond QuantCore's internal crisis. It had become a focal point for a larger conversation about the vulnerabilities inherent in automated trading systems. By the close of trading on April 10th, the market had stabilized, but not without profound implications. Unofficial inquiries from regulatory bodies emerged, signaling that the ramifications of the day's events were just beginning to unfold. The watershed moment marked a critical juncture not only for QuantCore, but also for the entire financial marketplace. Questions surrounding algorithmic accountability, systemic risk, and the potential for future market disruptions lingered ominously in the air, hinting at the complexities awaiting resolution in the days to come. The day ended, leaving observers and stakeholders poised for the next chapter in a rapidly evolving narrative of technology and finance, one in which the stakes had suddenly grown alarmingly high. In the wake of the trading chaos on April 10, 2023, various stakeholders prepared for the ramifications of the event. As weekend discussions unfolded, executives from QuantCore convened with legal and compliance teams to assess liabilities. Conversations focused on the impact of the crisis on existing client contracts and potential regulatory violations. By April 12th, the firm initiated communication with the Securities and Exchange Commission, SEC, disclosing the incidents of that day while highlighting efforts to rectify the malfunction. Despite these efforts, the SEC launched a formal investigation into the trading anomalies, signaling a broader inquiry into the intricate web of automated trading systems. As the investigation progressed, additional disclosures emerged from other firms affected by the volatility. Reports indicated that several high-frequency trading platforms experienced unprecedented losses exceeding $200 million collectively, drawing scrutiny from investors and market analysts alike. Legal notices began circulating among affected parties, as widespread claims of breach of fiduciary duties were prepared. The interconnectedness of the algorithms became a focal point. Other firms sought assurance from their technology providers on risk mitigation strategies to prevent future incidents, prompting a thorough audit of algorithms across numerous trading platforms. Amid this escalating tension, media coverage intensified. Prominent financial journalists published detailed analyses that illuminated potential warning signs preceding the incident. Leaked internal emails from QuantCore indicated that concerns regarding the algorithm's responsiveness to market shifts had been flagged months before the incident, but subsequently dismissed. Documents and chat logs suggested that voices within the company had urged for a slower rollout of the updated algorithm, citing conflicting projections from prior backtesting results. These revelations compounded the pressure on QuantCore, raising questions of oversight and accountability within the firm. Over the next month, QuantCore's reputation began to suffer significantly. By late April, numerous institutional clients decided to withdraw their capital, prompting executive resignations as stakeholders demanded accountability. By the second week of May, the firm's stock price had plummeted, and analysts began forecasting potential bankruptcy unless a substantial capital infusion was secured. The SEC's investigation resulted in increased apprehension from existing clients regarding compliance risks, heightening the urgency for the company to regain their trust. Throughout May and into June, the fallout continued as details of the investigation leaked further into the public domain. In late June, amidst worsening financial conditions, QuantCore announced a total restructuring plan, which included layoffs of approximately 30% of its workforce. Additionally, the firm faced subpoenas from the U.S. Department of Justice, which was probing potential allegations of securities fraud linked to the trading errors. As inquiries revealed deeper systemic vulnerabilities, the collective response from the industry led to a renewed emphasis on regulation in algorithmic trading practices. By July 15, 2023, QuantCore's viability dwindled further as pressure from creditors intensified, culminating in a Chapter 11 bankruptcy filing. The decision to restructure under bankruptcy protection marked a significant operational shift, aiming to renegotiate debts and stabilize liquidity. Regulatory bodies began enforcing stricter guidelines on automated trading algorithms, with new requirements mandating transparency and real-time monitoring of algorithmic behaviors to prevent recurrences of similar market disruptions. As the dust settled, QuantCore's assets were sold off to strategic competitors, signaling an end to its direct operations. The consequences of the incident had reshaped public trust in automated trading practices amid an unwavering demand for accountability in the financial sector. Discussions regarding the dangers of algorithmic trading culminated in new legislative proposals aimed at enhancing reporting standards and ensuring market resilience. Final reportings on January 30th, 2024, indicated that QuantCore had exited bankruptcy, yet it now operates as a significantly diminished entity, focused on compliance and regulatory adherence under new ownership. The market had since adjusted, implementing stricter controls on algorithmic trading, reshaping the future landscape of financial technology and trading practices.